Going to start off as I usually do with kind of a summary of what's going on with the stock market right now. For this last week at least, to talk about what we're seeing as far as that goes. So I'm going to switch over to the chart that we use every week. So we've been looking at this for quite some time. You see that first dip that's right over that Talk Money with Tom logo there. That was the last time we did tariffs.
Mm-hmm.
It dropped 19.6%. What's kind of amazing about the drop that we've had so far, although it's faster, you can see it's a steeper piece, roughly the same amount of drop so far. The difference between those two time frames was that the magnitude, right? You're talking about a 10% tariff essentially on China originally. And so if you look at what happened, this week, we ended up at right now at 145% tariff on China, which for all intents and purposes is a blockade of Chinese products. And just today, China has announced a 125% tariff on American goods coming into China. So obviously this week, they started off with this Liberation Day tariffs. Those got paused. The market skyrocketed on Wednesday,
Yeah.
9.5% because of that pause. Ended up dropping, 3.5% yesterday, because the reality is that when you look at the overall what they call the net tariff, so if you take a look at the tariff for each country and then how much they actually import into the U.S., the net tariff was 22.7% after Liberation Day last week. And so now we don't have all of these retaliatory tariffs. We have a 10% tariff across the board. We have 25% on Canada and Mexico with a few carve-outs, to 25% on cars, imported cars and parts and what have you. But everything was given up except for the tariffs on China, and we actually raised those. So it's come up from 54% to 145% just this week. And now our net tariff, because China is such a big trading partner, is actually at 27%. So unfortunately, the actual tariff, the cost of these tariffs and what have you, has up, even though there was a pause, a 90-day pause on all these other tariffs. So, Vietnam went from, I think, 46% tariff to 10%, just like everybody else. And so, that's good. But the overall, trading volume that we do with China is a problem. So we, last week, as we mentioned, we had a 63% exposure to the stock market for our average client across the board. We moved that down to 23%, and just getting out of the way of these big tariffs, and market was falling dramatically last week also on Thursday and Friday. There's been a total of $6 trillion that were lost just on those 2 days in the stock market. And then we've been looking for the news of these tariffs starting to lighten up or stop or change. And so the pause was good enough for us to move back in. We're currently almost 35% in exposure. So we're about half-ish where we were before, a little bit more. But that's not a bad spot to be right now, kind of splitting the difference. So the rest is in T-bills or ultra short-term bonds or short-term treasury ETFs. And we're just kind of wading through all of this stuff as far as that goes, because the China tariffs are dramatic. I mean, actually, I saw an interview with a lady who runs a small business, 5 employees. She has what was $30,000 worth of goods. It's called Busy Baby. They make these little mats, sitting ready to go on the boat in China. But, with the tariff, all of a sudden it was going to be nearly 200,000. She's a little business. She's leveraged against her house, got these 5 employees, and they can't ship it. They can't afford it. They don't have the $200,000 to get to pay when it gets here. And so she said, we have 2 or 3 months worth of inventory. And, after that, we don't have any revenue. We won't be able to keep going. They talked about the possibility of, hey, maybe we ship this to Australia and then repackage it and ship it in with a 10% tariff that Australia has, which is kind of interesting thought process. But she said the biggest problem that they're running into is just the policy keeps changing about every 36 hours. And so making a big commitment. She said, we could try to make these here in the U.S., but we're about 6 months away from being able to do that with the tooling and what have you. And so if you look at that, that's a real life situation, and this is one small business and what's going to happen. I think the thing that's interesting in there, it's quite dramatic. Okay, you can't overcome this level of tariff, which to me means that these tariffs won't be here at some point in time, which is probably why you want to be half in the market. Because when they eventually have a situation where they get together and negotiate out some kind of tariff that makes more sense, uh, the market will probably jump quite a bit. Matter of fact, it's up today. Trump is doing an interview today. It sounded better. He's talking about, he's waiting for the call from China. So it's kind of like who's going to blink first, who's going to call first. We're not willing to call China. China's not willing to call us. But somebody's going to call somebody at some point in time, because you look at China, they were already in a situation, prior to these tariffs where, they've got huge property debt, lot of leverage in their property market, a lot of empty cities, actually kind of incredible, that have been built. And so there's been, ongoing problems in China. We can see it in the deflation that they've had. We can see it in the stimulus programs that they're talking about. They stayed locked down during the COVID piece probably longer than most, and that created problems, and they're still trying to come out. So to take your biggest trading partner, which is us, and have a trade war. They're trying to do their best, but they have a big chance of blinking, because this is going to be pretty tough to do. Mm-hmm. On the other hand, on our side, we're seeing all kinds of problems also. Matter of fact, the big story that came out about why the pause may have happened, on Wednesday, was because of the bond market. So Monday, Tuesday night, the bond market was really, really having troubles. And so the Treasury market is the most important piece of this whole puzzle. We're looking at the stock market here. It's very important, but nothing. I always talk about how, like, in relative size. So if the stock market is a baseball, the bond market is a basketball. Mm-hmm. Right? It's significantly bigger. But more than size is the importance. We can't pay our bills if we can't sell new treasuries. So we did have a treasury auction this week. It went okay. This was after the pause. But when you start to see all of these currencies doing better than us at once, that usually means that foreigners are selling our bonds. Mm-hmm. And if you raise tariffs really high, one of the problems that happens there is that foreign companies will often sell to us, get U.S. dollars, and sometimes want to keep those dollars, and they'll park it in treasuries. And so if we have a large budget deficit, which we do, we have to continuously put out bonds to be able to sponsor that deficit. If we can't sell bonds, that house of cards really falls apart. And so, that's, to me, that I watch the Treasury auctions and the Treasury market really more than most, just because I think that's the key thing. We've always bailed ourselves out of all these problems by basically doing these stimulus bills and all these different things that we've done. Well, that takes money, which takes, selling these bonds. Mm-hmm. And so the other part of this that's quite important is that there's 9.6 trillion, roughly a third of our debt, that comes due in June. So we're going to have to issue a massive number of bonds to be able to pay those old bonds off. And obviously, one of the problems is that the old bonds we're paying about 2.7% on. That's what the article said, and the new bonds, are obviously going to come out at higher rates. And they've been trying to bring rates down, and maybe that's even why we're doing some of this craziness. But now rates are going up, yep. And they went up a lot this week because of the fear of the U.S. Is it a safe haven anymore? Should we keep money there? China has. Depends on the article I read, someplace in the $600 to $800 billion worth of U.S. debt. It used to be much higher. They've moved down. But China looks like they might be selling some of the bonds also. And one of the articles I read said it's because not so much as a strategic threat, it's because they have to. And they're getting ready to absorb and to support their industries that might be affected by this big tariff in the U.S. So all of this stuff, in my opinion, is going to lead to a situation. I mean, it could be tomorrow for all we know, over this weekend. It can't be too long, though. Mm-hmm. It can't be a month from now. Maybe it can. You look at that busy baby, this CEO, she's talking about having 2 or 3 months worth of inventory to sell. Every place probably has something that they can keep going with before they're going to hit some real potholes. But in essence, you're going to bring the whole house down if you keep that tariff there. I think both countries kind of know that.
Yeah, it's kind of like a term that's used in nuclear war is called mass, mutually assured destruction.
Yep.
And that's kind of like what they're talking about, the MAD, yeah, like principle. Like, is China and the U.S., with this tariff war, going to basically destroy each other?
Yeah, because I mean, this is a global economy. You can't have the second biggest economy in the world, this being China, fall apart and and then not affect us, right? Or not affect the rest of the world, and not affect Europe, not affect South America, and so you're pushing this country to the brink, trying to get them to negotiate. Um, and I think they will, but if they don't, we're not going to come at it's mutually assured destruction.
Yeah.
It is, and so I think there's awareness on both sides of that. Sometimes it takes that extreme, like on Wednesday when they did the pause, and the bond market's falling apart, and that seems to be. I heard one quote where, and I don't know if this is even true, but what Trump was talking about, I'm okay with causing a recession. I don't want to cause a depression. If that's a true quote, it's actually a little bit disturbing because I'm not even that confident that we should be having a recession personally, especially since we were doing so well before. And one of the problems that we're having here is what's the outcome? What are we trying to accomplish here? So we get all these tariffs, it brings in this revenue supposedly. They're probably going to get less revenue than they think because when you raise prices, the demand drops.
Yeah, demand destruction.
Yeah, demand destruction. But let's say they do get money. Where's it going? We don't know, right? And so it'd be nice to know some type of a plan that would create some confidence. But again, the market is going up today. If you can see the chart there, that's a weekly data. This week is up, versus the last several weeks. Is this a real return? These tariffs have been paused for 90 days. That gives them a chance to get some negotiations in. That sounds good, but we really have to solve the China problem as far as that goes, and somebody's got to call somebody, to make this start to happen. So anyway, that's what's going on. Like I say, we're about half-ish back in from where we were before. That's going to be different for all of our clients. Some clients are going to have more exposure than others, just because it's not even. Big chunk of what we did not sell was highly appreciated, assets that clients had. Some people don't have any of that. Some people have a lot of that. So, but just to kind of understand, what we're thinking about. And again, we're looking at this not so much from what the market's doing, which is what we normally do, just because this is a manufactured crisis. And it was manufactured by putting these tariffs into place, and maybe even the way that they were done, the speed that they were done, the way that they were calculated, all these things. But nonetheless, it can also be taken away really quickly. And it makes very, very difficult time frame to see what's going to happen. And it's actually a really dangerous gambit, as we saw on Wednesday when the bond market started to implode. And they're playing with fire. I'm not sure anybody knows how everything is connected. It reminds me very much so what happened in 2008. We were down 27%, and Lehman Brothers is coming, begging for a bailout. 150 billion, I think, was the dollar amount. We had just bailed out Bear Stearns literally the week before. Did not bail out Lehman Brothers, and the Treasury Secretary and the Federal Reserve Chairman are neither one of them knew the ramifications, and these people should know, but didn't know about these credit default swaps, these insurance policies, and how many had been sold that were put on top of these mortgages, which were all starting to fail. And basically everybody had to sell everything. And so when you do what we're doing right now, that is the danger. And that's why you want to be at maybe a 50-50 spot here, just because something could break. It could break pretty quickly. It could be kind of dramatic, whatever that might be. And it's probably not something we're even talking about. That seems to be what really creates a lot of the biggest downturns, is something that we're really not discussing. It's hard to see. I mean, we're talking about this basis trade. Apparently, there's almost $1 trillion of money in these leveraged hedge funds doing a trade against Treasury futures versus Treasury bonds, basically trying to scoop up a little bit of a differential there as far as that goes. And so you're unwinding that. You're selling off your Treasury. So, these are things that are, very difficult to see. Sometimes they're private transactions. I mean, they didn't realize that there was $7 trillion worth of credit default swaps in 2008, and most of those had been done in about a 5-year period, and so money can move into things very quickly. And so anyway, that's where, I'm optimistic actually that in the short term, next week, the week after, we'll probably have some better results out of China, at least with that tariff, because it needs to happen. If it doesn't happen, we'll probably be glad that we're half out, because of these situations. You take this busy baby, and that CEO and what she's saying, and multiply that times all of these businesses that are out there selling things, and on top of the extra cost that's going to come through, it's not a good situation for the economy as far as that goes. So anyway, that's where we're at. I think that so far we're looking at a negotiating strategy as the best positive outcome that we can have out of this. So we'll see if that's true or not. But we're waiting like everybody else to see what happens. Let me go back to, there we go. So anyway, that's a summary for the week. Again, watch for the China story. That's the key right now. It's what everybody's really focusing on. I thought today's interview that Trump did was better. I thought he was softer about that. He's looking at it. He's talking more. It's not so much the bellicose thing that we've seen in the past. I think he's interested in trying to make a deal. And again, he doesn't want to lose face by calling, and Xi Jinping doesn't want to lose face by calling. So at some point in time, somebody will hopefully, calmer heads will prevail here, and we'll get something out of that. So anyway, that's what's happening this week. We'll be here again next week. We can talk about what's happening with the markets.